Hi, I'm Nick Curtin, Ford Asset Management. I'm joined today by Nick Balkin, Senior Portfolio Manager. I'm going to talk to you a little bit about risk and how to think about risk in the current environment. Nick, one of the anomalies investors are really struggling with this year is, if you look at a typical 60-40 type portfolio, there hasn't been much decorrelation benefits to those kind of investors. Equities down 25% in dollars, bonds down 20-something, property down 20-something, very few places to hide. Now, the economic and finance theory kind of tells us that these are meant to be uncorrelated, and there's meant to be kind of safety in one from the other, which is not really how the experience has gone this year. So this whole concept of a risk-free asset, I just wanted to start with that question. Is there such a thing as a risk-free asset in the real world?
Yeah, I mean, there actually is a risk-free asset. A risk-free asset, I mean, if you look in the economic textbooks, is a bond. A bond issued by a government, because the government will always pay you back. They have the ability to print money, they have the ability to give your money back. The problem is, and this is the definition of risk, is what actually is risk? Because they'll give you your money back, but in an inflationary world, they'll give you less than the inflation rate in some cases. If you're only getting 1.5% out of a US government bond, and inflation rate was 3%, you're actually going backwards. So yes, they'll give you your money back, but the problem is it risk-free? No, it's not risk-free, especially when compared to inflation. I used an example of Zimbabwe. I mean, Zimbabwe will give you your money back. Does anyone think that they've actually got their money back if they put their money in the Zimbabwean government bond? No. So technically there is a risk-free asset, but in reality, when you compare it to inflation, unfortunately, there are no free lunches.
So it's a hypothetical construct, which I think, to be fair to the original academia, is kind of how it was created. But in real life, it's sort of become this real thing in people's minds, because I guess bonds have performed so well for such a long period of time. Yeah. So if there is no such thing that we can anchor portfolio construction on, how do you think about building that portfolio from the base up?
I think it's different in different markets. I think there's no one way to build a portfolio. Sometimes we'll have a lot of equity, sometimes we'll have a lot of bonds. It really depends on the entry points of the different asset classes. The problem now is, and that's what you alluded to in your first question, is there are, both of them were highly correlated, because the lower bond yields meant that the equity market prices were also very high. So the reality was that they were both at extreme levels because of each other, effectively.
So Ford's got a fairly bearish macroeconomic outlook at the moment. We're seeing elevated risks everywhere. If you run through the MICE framework, there's a lot of question marks or red crosses, and we talk about being cautious. Yeah. But in our portfolios, we've had comfortably more than 60% in equities across the board, almost consistently for the last 3 years, and currently at about 65% in our balanced fund. So how do we reconcile what most people think of as risky assets, sort of 65% in equities, with what is a relatively bearish outlook?
It's a very interesting question, and I think this is something we've been trying to drive home with our investors. At the end of the day, that 65% is a construct of different stocks. If you were to buy the market, as I said a bit earlier, even though the market's fallen a bit, it's still expensive. But the important thing right now is it's quite a strange market, and it reminds me of the 2000 market, where it was very bifurcated. You had very expensive tech stocks, and then you had very cheap industrial companies. And even though the market fell quite significantly in 2000, there were many stocks that did very well. And I think we're entering that same sort of world where there are lots of expensive stocks and there are lots of cheap stocks. So you can't just look at the equity weighting on its own and make an assumption of the risk assessment. If we are going into that world that you speak about, where inflation is persistently high, one of the key ways to do it is via equities with pricing power. And I think that's an important thing, that sometimes people would say equities are risky, but actually that's the best way to keep up with inflation if you have pricing power.
So just turning to the fixed income side of the portfolios, where we've been absent for a long time until a couple of years ago, which was a reasonably prescient move given what's happened since. And valuation's looking a lot better from a yield perspective, and we quite like the asset class domestically, but still a relatively moderate level compared to many others, only at around sort of 10, not even 15%. Maybe just give us a sense of what keeps that number at that level, and why not more?
Yeah, I think it's a healthy number. I think we don't look at it relative to peers of the benchmark. It's still a very acceptable level. What we said at the opening was we're talking about equities and how they have the ability to keep up with inflation. Just using an example like Standard Bank, that company right now you can buy at book value or slightly below book value. it will give you a 9% dividend yield, which is fairly similar to the 3 and 5 year bond yields that we're achieving. It's basically a bond with some growth, because we still do think that Standard Bank will grow its earnings at least 5% given the current environment. Remember, the banks are geared to rising interest rates. It's important to know that some people think that banks suffer. We still do think that they're a beneficiary of rising rates. So it's just an example, but I think it's an example that alludes to how important equities with pricing power can outperform bonds in this kind of world. So I think, yes, we do have healthy bond exposure, but the equities is a better armory, especially if you've chosen defensive ones that give you a high dividend yield and can grow into the future.
So again, it's looking through the sort of asset class naming convention at what's actually driving the return and risk outcome of the actual security that we're investing in for investors. And maybe that brings us to the property side of things, where, the sector's been absolutely hammered the last few years. We all know why. And yields looking a lot better than they have for a long time, but we still pretty much aren't there, very low allocation. Maybe just some of the thinking behind that.
Yeah, I think it's an important one. Once again, don't fight the Fed, don't fight any monetary policy maker, and they've signaled that interest rates are going up. And the problem with the property companies, they struggle to pass that through. They have very high gearing levels, and the gearing will continuously go up as a result of the funding cost. And as I said, they're going to struggle to pass that through. The problem in South Africa is actually the municipal cost has become a much bigger portion of the operating cost, and we see that growing faster than the revenue that they can get from their customers. So the problem is they have a very negative jaws, which means their revenue is going up, but at a slower rate than their costs, and they also have interest rates going up. That's not a great place to be, especially since they are at quite high loan-to-value levels, meaning that the banks are watching them closely, that should the asset values come down, they could breach some covenants. So I think it's just obviously horses for courses. You can't taint all the property companies with the same brush, but I do think a generality is would probably steer clear of them.
So caution again. Just the last thing I wanted to touch on is this concept of liquidity. So often when we see markets going through these kind of inflection points, you get, I don't know what the terminology is, liquidity events, or you get things bubbling up in various parts of the market, even parts of the market that we all think are relatively safe. And there's the recent experience in UK gilts as a very topical example. How do we think about liquidity in the funds and how important it is, and how do we make sure that it's there when we actually need it?
I think given where we are right now, and it's so fluid, we're at inflection points that could get really bad. You want the ability to react quickly. And that's generally, we've always said we want a ability to be flexible, to be liquid, and that premium people don't always understand because there's no price for it. But we will show you how important it is if the market does really sell off, because we will have the ability to change the portfolio quite quickly to take advantage of it.
Thanks, Nick. So caution is the byword. With the current world environment of elevated risks, it's not time to be taking stupid risks, but at the same time, you've got to resist the temptation to put the money under the mattress. We have to have equities with pricing power, and we have to be balanced in our approach and be prepared to take advantage of the opportunities as and when they come. Thank you very much for your time.